G'day and welcome to The Call, 10 stock picked by you, two experts, 1 hour. It is Monday, the 12th of December. I'm Andrew Gagan. Good to have you with us. And our two experts on the show today, Gaurav Sodhi from Intelligent Investor and Philip Pepe from Shore & Partners. Gentlemen, welcome to you both.
Thanks, guys.
Is the Santa Claus rally just on pause at the moment, do you think? I guess we're awaiting the key CPI data out of the States and then the Fed decision. Is that what it's sort of dependent on at the moment?
I'm gonna tell you, Philip, I hate Santa Claus rallies. I just think it's a real distraction from what's important. And I don't want to suggest you can't have a bit of fun, but we've really got to keep our eye on the game here, which is long-term stock selection, and trying to predict the stock for 6 weeks of the year is folly and a distraction. And we have a rule at Intelligent Investor: we don't do it. And so that's all I'm going to say about that. But your point about CPI is dead on. These numbers are absolutely crucial because the market's quite divided. I think there's a camp that says we've peaked, and there's a camp that says there's more to come. And someone's going to be right, someone's going to be wrong. There's a clear divide in the market, and that's what makes things really interesting. Consensus is always boring. So these numbers are going to be really important. So yes, we're watching those. Couldn't give a stuff about the Santa rally. And when Christmas comes along, for me, the market shuts down, and I'm focused on Christmas. We'll come back in January and deal with it then.
Bar humbug.
Bar humbug as well. Add that to it as well.
Yeah, Phil, what are your thoughts? And like if CPI misses, it could be quite a big reaction, couldn't it?
Especially with the end of the calendar year, financial year, you might see people taking risk off and going on a holiday.
Just going on holiday.
If it's negative, it's shoot first, ask questions later.
Yeah.
So there's still a lot of nervousness, still a lot of, I'll buy something next year, but if it's bad, I'll sell this year. To your point, not my quote, but investing used to be a test match. And then it became a one-day match, and now it's very much a 2020. What's the next catalyst? We've got a catalyst in 4 days, so the market will probably do nothing until then, and then move in a big way on Thursday morning our time, and then no volumes next week.
Blame the millennials. It's that short attention span.
It is short attention.
I don't know.
So
I've been listening to this Santa rally talk for at least sort of 15 years.
Yeah.
Poor millennials, cut them some slack this time. I think it's us who've started all this.
But I think we will get some good data points into Christmas though, because retail sales are probably going to be strong. Consumers are still cashed up. We haven't yet to see the impact of interest rate rises. There's probably a difficult calendar 2023 coming up when the fixed rates roll off, fixed rate mortgages roll off. So we kind of all know what's going to happen, but let's enjoy the party for now, and then because people aren't focused on a 3-year view, and in a lot of cases it's 3 months view, and 4 weeks might look good. We'll worry about January post Australia Day.
I'd be really interested in your view on this actually, because for me, one of the great mysteries of certainly the second half of 2022 is the resilience of the consumer. I mean, expectations of everyone, myself included, has been a weak consumer, weak spending, and certainly weak retail results. And we haven't seen that anywhere. And people are still pricing retail stocks and discretionary stocks as if their spending is going to fall off a cliff. And logically, it should fall off a cliff. There's a huge expense coming for every single household. And you add to that energy and inflation. I'm very surprised by the resilience of spending. And I don't know whether it's just a delayed response or whether we've got this completely wrong. But I'm open to both prospects. I think it's possible. It's possible. I think unlikely, but possible that we've got this spending narrative wrong. But logically, it doesn't make any sense to me. So I think that's going to be a really important driver in the early part of 2023.
Well, you did have those elevated savings levels, in households, but I guess that is coming off quite significantly.
Yeah.
I mean, spending is still, in the States, is
but
still strong too, isn't it?
You'd think households know that there's an interest rate cliff coming. They should be moderating their behaviour now.
Yeah. So these are the households who borrowed expecting interest rates to never change because someone wearing a suit said interest rates won't change.
Well,
fair point.
But think of all those,
fair point,
particularly at the lower end, all those new home buyers that got in at the top of the market. And, I guess it's a question of what's the tipping point? Where do rates get to when you actually just start to see that pain?
But conversely, it might be a case of, okay, my mortgage repayment is going up next year, so I'll take that holiday this year. Or I'll buy that new trampoline this year, or
Seems
whatever.
mad. Seems mad.
All right, well, look, let's get into it. Our first 5 stocks of the day: Westgold Resources, Omni Bridgeway, Phoenix Resources, EQT Corp, and Noble Oak Life. Our Stock of the day is the gold miner St Barbara and its smaller peer Genesis Minerals have agreed to merge. A lot of M&A going on at the moment, actually. That combined company to be renamed Hoover House. The $541 million deal to buy Genesis will allow the combined entity to focus on the highly prospective Leonora district in WA. And St Barbara will also undertake a demerger of its non-Leonora assets, Atlantic and Simberi operations in Papua New Guinea, which will be held in a company to be known as Phoenician Metals. So, Gaurav, what do you think of the move?
Look, there's been talk of consolidation in that Leonora space for years, as long as I can remember, and this is the first time someone's actually come up and mopped up all these little operations. It makes sense. I can see the case for doing that. I think the test really is, in my view, Leonora has never been, there's a lot of gold there, no one's really made a lot of money. And I've always suspected that, the grades are low, it's deep in the ground. I suspect the economics in this area just aren't that great, but it could be that with the achievement of some scale, you might be able to run a lot of volume through centralized processing and you could make money. I think that's going to be the test here. I'm by no means rushing out to buy Genesis or whatever it's called now, but this is an interesting idea. It's an interesting experiment. I'll be watching this closely. It's about time someone actually mopped up this area and had a go. It's pleasing to see someone do it and do it rather sensibly, I think. St Barbara has been a mess for years, like one of some of the worst capital allocators in the gold industry. They've been mining this Gwalia mine almost profitlessly for years and almost decades, really. So I'm a little bit skeptical about how this will work, but I'm really impressed that someone's made a good go of it, and the plans look sensible. I think it's a good experiment. I'll be watching with interest. Certainly won't be picking up stock. We're in an environment where gold stocks generally are just incredibly cheap, and there is no need to go up the risk curve. You can play an easy game here, picking up good quality assets at very cheap prices. You don't need to do this, so avoid for me. But interesting experiment, keep watching.
Yep, okay. Phil?
We've got a buy on Santa Barbara, and for me, the proposed deal actually looks pretty good. So both companies are around about 500 mil market cap. Put them together, get a bill. Sweet spot for a lot of investors. You get a lot more liquid. Gold price seems to be recovering. I can't peek it, won't try to, but someone told me it hit the golden cross or something last month, and it's
that's how you do it. Finger in the air.
It's golden cross, so it's moving in the right direction. So happy days. But they've also got rising costs, labour, diesel, all that kind of stuff. So consolidation makes absolute sense, especially if you're at the smaller end like they are. You put two together, you get greater access to labour potentially, you can share some infrastructure. So I think what they're doing on paper, based on what's been released this morning, sounds like it makes sense. We already have a buy on Santa Barbara because of valuation, because a lot of
it is super cheap, isn't it? It is so cheap. Yeah.
Add some economies of scale and some synergies. It looks okay. I'm not the resources analyst, but have no reason to believe we won't change our call on this one. I still think it's Santa Barbara's a buy.
It's worth pointing out that gold is uniquely susceptible to inflation because you're moving so much dirt in relation to how much good stuff you got. We're talking about parts per million when it comes to gold, not much greater. In something like copper or nickel, some of the other base metals, you're moving a much smaller amount of waste, and so you can get away with a degree of inflation. In gold, there is nowhere to hide. The margins are so slim. The amount of gold you're moving is so small in relation to how much waste you're moving. It really bites the equities in high energy times in particular, because this is a very energy intensive process.
All right, okay, so that's our stock of the day. Well, it's actually going to continue that conversation because our first stock as picked by you is Westgold Resources. And Sumit asking, can an investment be made in this stock at the current price level, trading at about 76 cents? And you only have to take a look at the chart to see the pain that investors have suffered, certainly over the past year or so. So, Phil, Westgold, once again, you mentioned those costs, and that certainly hit this company with those diesel prices, up by more than 100%, supply chains, other inflationary costs as well.
And that's the issue when you don't have scale. So they had a good first quarter production report. I believe it generally beat expectations, but the costs were up greater. And on at least on consensus, it's still burning, call it 25 mil per annum in cash. So I'm avoiding or cautious the cash burners at the moment. They're probably in the right space in terms of momentum, in terms of the commodity price, but in terms of cash generation, not so. If you've won that pain, given current valuations, you'd probably hold it. I certainly wouldn't buy it if you weren't already there, because it sounds like their costs are growing greater than their revenue, so it's a hold at best for me.
It sounds like you're tempted to get rid of it though.
At 76 cents, you've worn a lot of pain.
Yep.
I mean, it's got, in terms of top line, it's got top line momentum. Gold price seems to be on the upside. Does today's announcement on Santa Barbara mean that, can anyone take these guys over? I don't know the space that well. It's a hold at best.
Yeah.
If you found something
Well, if you're
else.
seeing other opportunity in that space, potentially get out of that into something else.
You could switch.
Well, in fact, I'll ask you that.
I think that's a really important point. Yeah. I mean, if you're going to get gold exposure, you really want to maximize, because all these names, they're all different mines, but they'll rise and fall with the gold price. And no matter how good their operations are, or no matter how good their economics are, they will follow the gold price. So if you're taking on a higher risk mine, you really want to be rewarded with higher returns. And I actually think that's the case here. Westgold is a well-managed mine. It's just not a great mine. It's one of the higher cost mines in Australia. Over $2,000 an ounce it takes to extract a bit of gold, and most miners, good miners, will do that for half the price. So this is a high cost producer, but a high cost producer has its place. If you're a bull on the gold price, then this is actually not a bad place to be. The balance sheet's in good nick. Feels right. The diesel costs in particular have savaged the operation, but they've actually got a plan in place to put on a gas generator on site. They've got access to some gas. Pacific Energy, which unfortunately was taken over, but it's a great little business. But that's going to be running that plant, and that should materially reduce the energy costs in the future. So I think we've seen the worst of the inflation in Westgold, and if you're a believer in the gold price, I think you're being really well compensated for the additional risk here. I actually think if you're a believer in the gold price, this is an interesting buy. I'll go speculative buy on this. I'll hasten to add that it's not what I would choose myself. I just don't know where the gold price is going, and I would not act with that much certainty myself. But if someone has a crystal ball and thinks the gold price will rise, this is a great exposure to gold, and it will do very well if the gold price does well.
All right. Well, so for the benefit of those watching, then
spec buy.
Yeah. What would you pick though in the gold sector?
I think very tough to go past Evolution. I think at these prices, it's had a very good run up, but superbly managed business and managed for cash flow. So you get a lot of cash out of that thing. And there's a mine they've got in Canada that looks like they're making a little bit of progress on as well. I also like Gold Road. It's maybe the most expensive miner on the market at the moment, but what they're doing there, I think, is a fantastic long-term game. They're taking cash flows from a wonderful asset, reinvesting it in maybe the best exploration portfolio in Australia. And I'll throw in Ramelius, just as a management team who continues to surprise and pulls deals out that just make great value. So I think those three are the ones that I'd go for.
All right. Let's move on to Omni Bridgeway. Roger wanted to know a bit about this, thoughts, and whether you see strong growth ahead. It operates funds that essentially pay for litigation. Gaurav, what are your thoughts on Omni Bridgeway?
Yeah, we actually own this in our funds. We've had a buy on it for, I would say, probably 18 months, and sat there enduring pain for probably 15 of those months, and has finally, I think it's in the money now, which is not a moment too soon. There you go. So the case for Omni Bridgeway is that this used to be I would say a poor quality business. It used to invest in court cases, its own cash in court cases for a return, and those returns would come sporadically in lumpy fashion. And it was very hard to forecast how much money they would make. It was very difficult to forecast what returns they'd get. But these guys have a long record of taking good, acceptable risks and generating really good returns. So they've now pivoted that model to accepting external capital, and they earn a fee on that external capital. So instead of putting their own balance sheet on risk, they're actually clipping the ticket on someone else's money. This is now a fund manager, not just an investor in their own right. So you've got this consistent cash flow that should be coming in, as well as the kicker from their legal cases once they settle. So look, I'm quite happy still to buy this. I think it's cheap enough. It's not the bargain it was. I think when we were buying it, it was just it was a better risk reward. But I still think there's enough here. I don't think the market's onto the change in business model and how much it improves the business. I still think this is a buy.
Bill.
It's a sell from me.
We're not agreeing much today, are we?
That's okay. When I was a fundy, we invested in at least one of these stocks, and it wasn't a great experience.
Yeah.
Their track record's strong. I think they've got a 77% win rate, although they just lost a case on appeal that they've got in their books at 250 mil, so there's some cash outflow to come out.
That's right.
What you said all sounds good. They haven't made a profit in the last, they're still losing money.
Yep.
They've had a great big case book still. I always look at the track record. Their presentations talk very positively, but you're still making a loss, and yeah, you got tax credit, but you're still losing money. So if revenue is booming, for want of a better phrase, and you're losing money, when are you going to make money? They market themselves, if you think about what's available to you in the alternative asset space, they market themselves as an alternative asset manager. Buy Regal Partners. You know, you get a whole bit different types of assets. Regal can do this as well. It's not about Regal, but it's kind of like, do you need to play in this space? No. As you said, it's had a decent recovery. I would take profits and move on and find a different alternative investment manager if that's what you wanted, noting that they're possibly going to have another year of outflows in calendar 23. Correct me if I'm wrong. You've probably got time on this one, so for me, it's a sell, at least in the near term.
I actually don't disagree with a lot of what you've said there. I think they will have a difficult year ahead. The price has gone up, and you're right that the business model hasn't been proven yet. And I think that's the opportunity, though. It's the uncertainty that probably creates the opportunity. On any measure of success, the share price is just crazy cheap. So if it works, it's going to pay off quite nicely. But I agree, this is not without risk. And you know, I think for conservative investors, it's not a bad position to avoid it. Yeah.
Okay. Let's head back into resources now. Phoenix Resources. Simon wanting to know about this, thoughts in the current environment. It is an iron ore producer in WA. So interesting space obviously to be in, and also as to where that iron ore price is sitting at the moment. Phil, Phoenix?
I had to do a bit of research on this one.
Yeah.
Just macro level stuff. It looks like a buy. Iron ore price is recovering. Maybe we don't know why. It's probably China reopening related, but iron ore price went through $110 or so. Overnight, it's moving in the right direction. I'm often cautious of these smaller companies, but according to FactSet's 136 mil market cap, holds 100 million cash.
That's right.
And pays a dividend, around 20% dividend yield. Yeah. It's a buy. It's in the right space in Western Australia. It's holding a lot of cash. Most of its market cap pays a dividend. That sounds like a buy to me, just on those metrics. Knowing very little about the company, just on that high level analysis, it looks pretty good.
All right. Gee, it doesn't get any simpler than that, does it?
That's about it.
All right, Gaurav.
This is a tricky one. I've struggled with this one because those numbers are remarkable, and they're accurate. They're right. So this is $100 million. It's got most of its market cap covered in cash. And not only that, its production, about 100,000 tons of production, are hedged at crazy high prices. I would say once you add the value of the hedge and the value of its cash, and it's got a truck fleet that it owns, you got the entire market cap licked. And then you almost get a free option on iron ore production here. And the guys who run this business are sharp. They built this started off as a little, a pretty poor quality little trucking business. They got really high quality ore. I think it's about 65%, 66% iron, so they exceed the benchmarks, but their costs are really high because they have to truck these things around. They used to contract their trucking operation now around. $90 a ton was their cost of production. They since bought their trucking contractor, and over time we should see that come down to around $80 a ton. I mean, we have to remember that BHP can produce at $13 a ton. So this is by no means a sure thing. All we need is a 20% fall in the iron ore price, and these guys are out of the money. Their trucking fleet is worthless. This can all fall over very, very quickly, but they have a huge cash pile. I'd say management who have shown that they can make something out of nothing, although the management has changed, and I think that's probably the only thing that's keeping me from buying this myself. But I'd say a hold for now, just because for me, when you have a very obviously cheap price, I just get, price is not an investment case, you know. Everyone can see the price. It's not a mystery. I don't have a differentiated view. You know, if the iron ore price stays anywhere near this level, you're going to make some money out of this thing. But keep in mind the future production is strongly hedged. So it's not going to be as responsive to iron ore prices. But in 2 years from now, if iron ore prices are sort of $50-$60, which I think is a possibility, this thing is headed the way most Midwest iron ore producers go when iron prices fall, and that's in the big iron ore mine in the sky.
I mean, that said, share price hasn't really gone anywhere in the past 12 months.
It's a bit of a mystery because these guys are collecting cash, they're paying dividends, they're making the right strategic moves. I think there's a good entrepreneurial team at work here, but I think you do need some confidence in the iron ore price. If you have that, this is a fantastic way to get exposure. But for me, it's too cheap to sell. I'm going to go hold.
Yep.
But a fascinating little business, and one that I think confounds me a little bit.
All right, moving on to EQT Corporation. Dan wanted to know about this. It's a trustee company, offers asset management, estate planning. Been around for 130 years, so it's been with us for a while.
Yeah.
Gaurav, what do you make of this?
I'm surprised we don't hear about this company more often. We actually had this as a buy a couple of years ago and never made $1 on it. And it surprised me a little bit. This is a fantastic quality business, really. I mean, this is almost a roll-up of trustee services. They bought a couple of competitors and they now dominate that trustee space. And trustees is just really a license to make small amounts of money. It's very stable and reoccurring income. Margins aren't great, but they all get paid out as cash. You're looking at sort of a 4% yield. Without acquisitions, it doesn't grow particularly strongly, and sort of early 20s PE suggests to me that it's probably fairly priced. Look, I don't see a great opportunity here to make money, but if all you want to do is sit there and collect a 5-6% return on your money and do it without taking too much risk, this is a perfectly sensible way to do that. It's a hold for me, but nothing really exciting.
Phil?
Trustee business, it's nothing really exciting, but it is dependable. So I think it's a buy.
Yeah.
It made a recent acquisition in Australian executive trustees, which has only just closed. So they'll digest that in the next 12 months and get some decent synergies out of the business. Couple of things weighing on the stock at the moment, depending on which of their three businesses. About 30 to 70% of its revenue is linked to equity markets, domestic and offshore. Call it 50% across the group on average. So equity markets fall, their share price falls because the market does a one-to-one correlation. Even though they get inflows from their clients, some of which are superannuation based, the investors still see that as a share market proxy. So we spoke earlier about the Santa rally and what happens next year. If your view is some share market weakness in early 2023, this will probably follow it down in proportion. However, we think it's cheap. We think it's a good, dependable, recurring revenue business. You look at the interest in perpetual trustees. Recently, Perpetual is bigger, does other things as well, but there's a decent recurring revenue nature in this business. If you think genuine 3-year views, they digest the acquisition, equity markets get back to normal levels of growth once we rebase. It's a compelling entry level at the moment, albeit there'll be some volatility in the near term. So it's a buy from us, but just it may actually trade sideways or in proportion to the market.
Do you have any views on what happens to that trustee business inside Perpetual if all the mergers and everything goes through? Does that stay with Perpetual, do you reckon?
It's quite large. So, for example, these two couldn't. You would think ACCC, it could get carved out.
If that thing gets carved out, I would probably prefer that. That would be a great business.
That has more scale. That could get carved out. I don't think anyone offshore could buy it. There might be.
There's a lot of FIRB issues with trustee businesses.
I would have thought two fund managers getting together is for the funds management business in the back office, so they could carve it out.
They could carve it out.
I think that theory's been in practice. Play for 20 years. We might see it. I don't cover the other two stocks, but it wouldn't surprise me to see a carve out. And then you'll get, the space might actually get more attention. You mentioned not many people know about EQT. It's got a good register, but if you get a larger player that's listed, that'll attract more attention to the space, and then you might see both of them re-rate because more eyeballs on a bigger sector.
Okay. That is EQT. Moving on to Noble Oak Life, Michael wanted to know about this. It's a distributor of life insurance products. Seen quite a rapid decline in EPS over the past year, though. Phil, Noble Oak.
We think it's a buy. It's another stock or another sector that's now under the radar. Life insurance used to be a material part of our market. You had AMP, AXA, Challenger were a lot bigger. We then had the Hayne inquiry, and a lot of them were written up for the wrong reasons. We saw what's happened to AMP. We've now come out the other side. The Hayne recommendations have been implemented. APRA have stepped in. In terms of income protection, the industry lost about $1 billion in calendar 2021 because it became politically correct to make mental health claims, whereas previously people didn't do it, so everyone started claiming. APRA has stepped in and said, you guys need to price appropriately, you need more capital in the business. We don't want any of you to go broke. There will never be another HIH or FAI in this industry, in this country, because the regulator will step in very soon, as soon as they can. And that's what's happened. So coming out of post-Hayne, the industry has now returned to growth, grew 5% last year and is profitable after bleeding some money. So in terms of Noble Oak, they grew 40% last year, net earned premium growth versus a market of 5%. And they're forecast to grow, their guidance is to grow another 20% this year. They were the only life insurer not to be named in any sense in the Hayne inquiry. They've won a whole bunch of awards, and because people aren't really buying the big firms anymore, their market share is still small. It's gone from 0.6% to nearly 2% in that period of time, and growing profitably. So very conservative, very well-run business. And people may not realise that interest rate rises, given that they're invested in fixed interest, and at the short end of the curve, interest rate rises is dollar for dollar, straight to the bottom line. So restructured industry, they've done very well. They've grown their market share, a positive beneficiary from interest rate rises. We think it's a buy and very much under the radar.
Yeah, interesting it wasn't named there. Obviously the others, what was the Hayne pain for them? The Hayne gain potentially then for Noble Oak. So Gaurav, what's your view?
Look, life insurance is one of my no-go areas, I've got to say. It is, the accounting is what kills me. It is just so fiendishly complicated. We've done a big development thing on insurance businesses, because I think that by itself is complicated. But when we got to the life insurance part, I mean, that's another level above in complexity. Yeah, look, just for the sheer complexity of it, I don't know this business, and I don't understand the life insurance market, and especially the accounting, which I think it's a lot of discretion in life insurance. They can be good businesses, but they're really dependent on good management. So it's a kind of stock you have to know a lot about to be able to invest in. It's not usually it's, if you know the four most important things about a stock, I'd be happy to invest on that basis, and this is not like that. This, you really have to go into the weeds. I know Shaw's have done a lot of work on this, so I'm going to piggyback off them and call it a hold. I can't call it a buy because I haven't done the work myself, but I've read your report on it, and it is compelling, I've got to say. The opportunity sounds compelling, if you can understand it, which I can't. So I'm going to go hold only.
Well, the problem with insurers is both general and life is there's present value in the accounting statements.
That's right.
So interest rate movements affect the P&L.
And there's a whole lot of assumptions, but underneath that. So not only do you have to interrogate the number, you got to go back and interrogate all the 15,000 variables that go into it.
Yeah, I agree.
Yeah, it's hard.
Yeah, hard indeed. All right, well look, let's wrap up where we've been for the first half of the show then. We began now with our stock of the day, St Barbara, given its buying Genesis to become Hoover House. Interesting name, we haven't got to the bottom of that.
Do we know why it's Hoover House?
No, someone's going to tell us.
Yeah.
All right, so it's an avoid from Gaurav. He acknowledges it's going to give it a scale, but just wary of, given where it's been, particularly operating in Gwalia, hasn't really made a fist of it for decades. Phil, though, has a buy on it, sees St Barbara as very cheap. Staying in gold, Westgold Resources, Phil's saying a hold at best, acknowledges the cost. I mean, it has been hurt, particularly as far as that diesel price is concerned, which has more than doubled. Gaurav's saying he's got a speculative buy on it, saying it is a high cost mine, but got a good balance sheet there. But it's not his favourite. He likes Evolution, Gold Road, Ramelius, thereabouts, given what's going on in the gold space at the moment. Moving on to Omni Bridgeway, a buy from Gaurav, saying it's cheap enough, whereas Phil, a sell, saying, well, look, it's losing money. Phoenix Resources, back in the resources space there, a buy from Phil, looks ticking all his boxes, and Gaurav saying, yeah, look, acknowledge it's got a great cash pile there, but he goes as far as a a hold. And EQT Corp, a hold from Gaurav, a buy from Phil saying it's dependable and cheap, and finally Noble Oak there, a buy from Phil and a hold from Gaurav. All right, to our portfolio that the call is tracking, which is picked by our investment committee. The latest episode of that is live here to watch at ausbiz.com, so let's check in with the update. Going into this month, and in the income, Bapcor and Domino's, they were removed in fact. Index and Janison Education were added, and Elders Weighting was increased. So, to the performance thus far from the beginning of March, it's up almost 8% on a cumulative return basis. So, keep sending in your requests, keep the call switched on to see which stocks our committee will be looking at next. Well, the ones we're going to look at next: Deterra Royalties, Kina Securities, Flight Centre, Jupiter Mines, and Brickworks. So, to Deterra Royalties, Joe wanting to know about this. Look, it extracts its income via royalties, as the name suggests. But certainly, given the weak iron ore price this year has been affected, essentially the share prices has gone sideways as a result. So, Phil, Deterra.
Interesting business, different way to play the iron ore, get the exposure to the price without the costs. Despite going sideways, actually looks like it's fair value on analyst estimates and pays a good yield, 7%. For me, it's a hold though, because I mean, iron ore seems to be moving upwards, but it's not exactly cheap. If you look at that share price charts, at near record all-time highs. So if Gura is right, or suggests we get a downturn in the iron ore price at some stage, that's going to come down dollar for dollar. So at current levels, for me, it is a hold at best. Take the divvy for the next 12 months. Iron ore is probably going to be okay on the short to medium term. But for me, it's a hold at best. But an interesting way to play the iron ore price without having any mine-specific risk.
So what do you think of the iron ore space in general then at the moment? What's the view from Shores, given, I mean, so much of that depends on China, of course.
Look, our analyst has called it well. Iron ore price fell in a heap as China, perhaps as China went into lockdown. China's coming out of lockdown, iron ore prices recovering. So after the falling iron ore price, we were reasonably bullish on many of the iron ore stocks, Fortescue in particular. They've now had the rally. So iron ore, I think, hit a $110 or something overnight. So it's moving in the right direction. I can't pick commodity prices, but as a house, not me, but we called the bottom reasonably well. It's probably closer to fair value than it is cheap at the moment. So if you bought a month ago, 2 months ago, you might want to think about taking profits. But I'm not an iron ore forecaster. You'd think it's got a bit of momentum as China opens up, if their demand comes back to normal. So maybe there's 12 months more of positive momentum. But I can't pick longer term. We'd probably get more supply over the medium term. So in terms of this particular stock, I'd be cautious medium term. No reason to sell it. But, I'd have my finger on the sell button if it kept rallying.
All right. Gaurav, might get your take on the overall sector at the moment, but then specifically, obviously, Deterra.
I'll preface everything by saying I've been wrong on iron ore for at least 2 years. It has really surprised me. I would have expected weaker iron ore prices, and they've really surprised by their strengths. And the reason I've been a little bit cautious is just the supply. I mean, the big guys are incrementally bringing on new supply, but Simandou over in Africa, which is just a fantastic quality iron ore basin, but stranded in the middle of nowhere, requiring a huge amount of infrastructure investment. The Chinese are doing it, and I think it looks as though that's going to happen. You know, this has been talked about for about 15 years, and it looks as though it's happening now. I think in sort of 5-6 years' time, we could have another 100 million to 200 million ton exporter on our hands, and that will completely disrupt the iron ore market. And that really worries me. I think the market's going to start. It has to start reacting before that happens. And as I said, there's small increases in production from the existing supply chain as well. Iron ore is fascinating because it's not really mining, it's logistics. And you find that everywhere in the world where you get, the reason why iron ore is the most profitable commodity pool is because you can only really extract iron ore with existing infrastructure. So you find all the additions to global supply come from existing basins. And you can't, that's why high prices can't incentivize new production, because you got to sink $10-15 billion into building an infrastructure chain before you can start mining an ounce of iron ore. and it only makes sense for the Chinese state and no one else to do that. So iron ore is a wonderful place to be when it's working. We've had strong prices now for a good 10 years, and I think we might be at the end of that. I mean, I've been wrong about this so far, but I think we're on the verge of a change in iron ore, and I think we're looking at more supply. There's a brand new basin coming online, and once you have a new basin, it's really cheap to incrementally increase that supply. And it's terrifically disruptive to the iron ore market. So I'm negative iron ore. We own BHP actually, but it's really just as a protective measure because I'm tired of getting knuckle dusted by the iron ore miners. So we hold a big chunk of BHP as a counter against that. But to Terra specifically, if I could pick one business to own on the ASX, I'd probably pick this one.
Wow.
If I could own the whole company, and if someone said to me, you can own one business, I'd probably pick Terra simply because you don't need to do anything. They have a royalty, I think it's 1.23% on the mining area C, the most important part of BHP's iron ore production. They're actually tripling or 2.5xing production from that area as we speak, and that should happen in the next few years. So Terra is going to have a meaningful increase in their revenue and dividends without incurring a single dollar of capex. It is a magnificent business. My fear is that management is going to stuff it up. In fact, I know they're going to stuff it up because they've already told us. They said they want to go out and buy more royalties. This is the single best royalty in the world. Anything they buy is going to be diluted. It's going to be diluting this one. So if the blokes running this business wake up and realize they got one of the best assets in the world, and all they have to do is wake up in the morning, sign a check, and go back to sleep, I'll happily buy it. But until then, I can't put a buy on it. It's a hold only, and it's interesting lining this up against Phoenix, because if you're a believer in the iron ore price, both of these two things should work out really well. But this gives you a lot less downside than Phoenix does. So I bring that up just because if you're interested in buying Phoenix and you're a believer in iron ore, you got to have a look at this one as well. But a hold for me.
Yeah, interesting. All right, let's head back into the financial sector with Kina Securities. It's a diversified financial services company, billing itself as offering those end-to-end solutions, if you like, from savings accounts to business loans and mortgages, and also financial advice and investment management as well. So a lot of scope there. Gaurav, so how are you seeing Kina?
This is an astonishing business. Absolutely astonishing. If you, if you're used to looking at banks, CBA trades at, what is it, Phil, 2.5 times book or something, making a 12% ROE. This thing makes a double-digit ROE and trades at half book. Number 2 bank in PNG. I used to work in PNG for a short time, and I can tell you it's a interesting place and often scary place to do business. But these guys have stumbled on a way to make it happen. There's also a little wealth management business in there that's growing. It's a very different proposition to the banks we're used to, which really, our banks really are very low risk because they most of the loan book is in mortgages, and it's well covered with assets, whereas this, only a small amount of the loan book is covered with assets, and it's really a term sheet dominated loan book, which makes it higher risk. So it should trade at lower multiples. And so I think the current price is kind of, look, it's cheap, but it probably makes sense for a bank with a lowish quality loan book operating out of Papua New Guinea. But I've got to say, management looks terrific. They've really done some really impressive things with a very limited pool of resources and a limited opportunity set. The numbers are all astonishing. Look at the NIMs on it. The potential growth from the funds business is really, it's absent from the share price, really. You could buy this just as a cheap bank and get the other business for free. Look, I'm going to call it a speculative buy. I can't believe I'm doing it, but I'm going to call it a speculative buy. But this is a high risk investment, and only those with iron stomachs should apply. But it's too cheap, I think, to ignore, and there might be good reasons for that. But I think you're being well rewarded for taking on additional risk.
Is it just Papua New Guinea?
Yeah.
All right, and that is part of the concern there. What I mean,
I think Australians sometimes have romantic notions of Papua New Guinea. when I was there, I remember I used to go to the Chinese restaurant in Papua New Guinea, and I went there one day, and the owner of the restaurant wasn't there, and it turned out the gangs had beheaded him. I used to live in a compound, have armed escorts everywhere I went. This is one of the most dangerous countries in the world, where the government outside 2 cities does not exist. So to do business here of any sort is really hard. But some people can make this happen. And it looks like these guys have a real business. It's just you want to discount that very heavily.
All right, but with high risk.
Yeah.
Phil.
I actually got approached for a role in PNG a number of years ago. We'll put you in a compound, there'll be securities, and you can go running inside the compound, just not outside the compound. I'm like, no. I don't have your stomach, it's a sell from me. Just last week, sovereign risk.
Yeah.
The government's proposing increasing the tax rate from, 30% to 45%. They pushed the share price down 20% on the day.
Right.
And we don't know what the outcome will be, and that's probably 12 months away. So that's what can happen in PNG. Yep. Mind you, look at what we're doing with coal in Queensland and gas. So, glass houses. But that's a very real reminder of sovereign risk. And when the government says, we're just going to tax you more because we can, I don't have the stomach for it. So for me, it's a sell.
And that top bank, I think it's the Bank of South Pacific, I want to say, but the number one bank is really well connected politically. You can guarantee whatever measures that Kina has to pay, those guys probably have a loophole to get out of it.
So if there is a loophole and they can get out, then it's cheap if you have the stomach for it. This is still happened last week, so this is months to play out. So for me, I would look elsewhere.
All right, okay. So it's purely speculative.
Outside the compound for me.
Fair enough. All right, let's come back home. Flight Centre in the travel space. Of course, we know what it does. And, interesting, of course, as we get back flying, and lots of talk of gouging, particularly as far as the airlines are concerned. So, Phil, how do you see, how well placed is Flight Centre then at the moment?
Flight Centre is a great business. It's been through a tough time, and the sector's having a Santa Claus rally. We've seen...
Don't tell him that, he hates that.
Well, I think it's the music will stop. So I'm calling it a hold because you look at what some of the smaller places, they've all put out these great trading updates. Qantas, some of the smaller ones have all said, hey, we're having a great start to 2023, let alone 2020. That's because people couldn't fly, people were stuck at home. Businesses, leisure travel, all just paid the tax, paid the higher prices, saved up some money, whatever. People paid the extra premium to fly somewhere, the extra accommodation. That's going to stop. Around 28% of their revenue last year was in the US. That handbrake's been pulled. We know that. We're going to, economists are talking 5% interest rates in the US. That handbrake's being pulled, so their leisure and corporate business in the US, you think, will slow. Australians, very anecdotally, business costs are through the roof. People will fly if they have to. They might fly once, but now there's Zoom, and Zoom's part of the norm. Working from home's part of the norm. Leisure travel, even those who can afford to travel are saying, well, I'm not paying twice what I would normally pay. In some cases, people are saying, look, I'm stuck at home. I'm going away this year. Damn it, I'm going away this year. So they're all putting out trading updates because it's 2 years of pent-up demand fueling these good results. So what happens next calendar year when the interest rate rises start to bite in the US and in Australia? So I'm cautious that this is a Santa rally in the whole flight, leisure, travel sector. We still haven't got students coming back to Australia in a big way. So the permanent travel hasn't yet begun. This is, in my opinion, this is a temporary spike that's pushing a few of these companies up. I would take profits. Hold it. It's great business, great longer term investment, but I just see a challenging 2000 because we're getting the mean reversion from 2 pretty tough years. So people are overspending at the moment. I think that will mean revert in calendar 23, and it's too early to buy this type. It's a good long term investment. So I call it a hold. It's not a sell, but I think these stocks are over-earning at the moment, and capacity will come back on, and prices will come down. Therefore, they'll be cycling some high comps in about a year or so.
I mean, that said, the share price has never really recovered from the COVID cliff.
Sure, which way it's not a sell. So there is some value there. I just think in PE terms, the earnings might adjust to make it look fair value in PE terms. And look, to argue that flight patterns will get back to where they were pre-COVID, I don't think that's right. Leisure will. leisure, of course, will. In terms of business travel, Zoom is here to stay, or video virtual's here to stay. So I think people, I'm just pure guess, for every 3 face-to-face meetings they used to have, might be 1 will be virtual going forward, because once you've had the initial meeting, you follow up by Zoom as opposed to having to fly, where you would normally do the Zoom where you'd normally fly.
All right, Gaurav?
It's taken us 8 stocks in, but I think we have a point of agreement finally. Finally. Yeah, look, I largely agree. This is a wonderful managed business. We've owned it on and off for years and done really well every time we've owned it. I think you're right, Phil, to particularly point out the cyclicality in this. And of course, everyone knows travel is cyclical, but this one, inside Flight Centre, is, I think it's the world's 4th or 3rd biggest corporate travel business as well. Like, there's a substantial amount of corporate travel profits embedded into Flight Centre, and often doesn't get, they don't highlight it or split it out particularly easily, and so it's easy to miss that sometimes, but it's there and it's highly cyclical. I agree there's a lot of discretionary unknowns here, but I also agree that this is just a really well-managed business, and they took the opportunity at COVID to change the business model around. They went through a huge change and shut down hundreds of stores, and it's now a much more leaner, online-focused business than it ever has been. I'm going to give it a hold. I think the valuation has come down enough to make it worthwhile holding especially for longer-term investors, but I certainly would not be allocating fresh capital to anyone in this sector. Actually, I agree with that sector-wide verdict as well. I think this is a special year, and I don't think we should extrapolate this year's results in the future.
Okay, Flight Centre. Let's move back to resources. Jupiter Mines. And Jane wanting to know about this. It's in manganese. It's based in Perth, but we're close to a 50%, just less than 50% interest in a manganese mine in South Africa. And what manganese mostly used? What, steel making?
Hardened steel.
Yeah, but also in batteries too. I think to a degree.
We'll get into that.
Yeah. Okay. All right.
Yeah.
Okay, Gaurav, go for it.
Yeah. So look, let's get this out of the way. 95%, maybe more, maybe 98% of the world's manganese supply is used to harden steel. At the moment, only 1 or 2% is used in battery, and manganese as a battery metal, I would say it's not settled yet. I know everyone wants to call everything a battery metal. I think the most worrying part of the market at the moment is the battery metals. It smells like I'm not like I'll say it, bubble. It smells like a bubble to me, and if I'm wrong, so be it. But I don't want to participate in it. Manganese is not yet a battery metal. A couple of years ago, the price of cobalt went bonkers, and the battery makers showed amazing ingenuity in changing the chemistry of their battery composition to exclude large quantities of cobalt, and in doing that, they had to substitute it for manganese and nickel. So there is a battery chemistry available that uses a decent chunk of manganese in one of the, I think it's the cathode, but it's not the norm and it's not settled yet. So look, I would not price this as a battery metal. It's possible that manganese supply is in manganese demand takes off, but I don't think it's quite settled yet. So for me, this is still very much a steel-focused metal. The good news for Jupiter is that they own one of the great mines in the world. There's a area in South Africa that just responsible for the bulk of the world's manganese. It's I forget the name of it, but most of it comes from here.
Shipibuwa.
That's one of the mines. Shipi is the mine that they own, but there's a whole belt. There's probably half a dozen mines along that belt, and all of them are fantastic. Shipi's probably, I think it's the 4th biggest manganese mine, I want to say, in the world, and it generates fantastic returns, fantastic free cash flows. I guess the only problem is that it's in South Africa, and business in South Africa has gotten really difficult. The other half is owned by a South African company. They've got these really arduous laws, labor laws and ownership laws in South Africa, where equity stakes kind of get pinched. Labour laws are really difficult to manage. There's a tendency for miners to invade the turf and overrun it. And power is the biggest problem in South Africa. That Eskom was the utility. It's completely dysfunctional.
Yeah.
They're still making a lot of money. Look, I'm torn with this one. I'm going to go a hold. The manganese price is going through a bit of a cyclical funk, in sympathy with the steel price. And I think if you're ever going to own it, now is not a bad time to tip some money in. Mm-hmm. I'm not convinced. I think there's a really good asset here, really good management here. I'm worried about the counterparty. I'm worried about South Africa. Are you being compensated for those risks? Not sure.
Okay.
So I'll go hold.
Kalahari, manganese.
There you
field.
go. Thank you. Well done.
Okay. That's the power of Google. Phil.
I agree with everything's spec buy from me because
I can see that.
10% dividend yield for what?
Actually, you know what? You're right. I'm going to go spec buy as well.
There you go.
Okay.
That was.
Yeah. I think all I needed was a little nudge. You're right. Yeah, it's cheap enough. Gone.
Yeah, but it's exactly that. If you look at analyst, it's well below, almost half analyst valuation, 10% dividend yield. My understanding is manganese can't be recycled like steel can. So if it's going to be driven up by demand for steel productions, it's going to follow the iron ore demand upwards. Yeah. Maybe, I'm not an expert in the area, but it seems to me the macro is suggesting it got not be terrible buying.
You've got some optionality.
You've got the 10% dividend yield. So I agree with everything you said. Spec buy, not a huge position, small position. At current prices is worth a look.
All right, let's round it out with Brickworks. Liam, what interesting about this? It is, of course, started out by making bricks, I should say, building products producer. Now it's sort of got a growing property portfolio, which is interesting, and it has that relationship with Soul Patts as well, as far as its stock is concerned. Phil?
Interesting business. Good trading update at the AGM, I think last week. It does have exposure to property and development, and they've flagged a strong start to the first half of the year with some potential headwinds in the second half as some of the projects roll off. But if you look at what comprises their net asset value of about $33, about half of it is Soul Patts, a diversified funds management business. So although a lot of the talk is about the property and the development, half their valuation is funds management, and Soul Patts is quite well diversified. So again, medium-term view, given they've never missed a dividend in over 40 years, the 12% compound growth over a number of years. It's been a good long-term investment. So an entry price at $22, theoretical value at $33 pre-tax. For me, on valuation grounds, on the long-term view, the fact that there's at least a solid 6 months coming out. Sure, we bounce off the bottom, but for me, it's a buy based on what they've delivered over a very long period of time. It's not going to be without its volatility, but it is more than just a property developer, a brick manufacturer.
Right.
And I actually didn't think that the agreement they put in place, I think a week ago, to secure their gas supply was terrible.
Yeah, agreed.
So again, takes away some of the uncertainty. So for me, it's a buy based on valuation and medium-term
that deal with Santos, in fact, 11-year deal to secure its gas.
And given
supply.
what might happen in New South Wales, that might, in hindsight, prove to be valuable.
Yeah.
Gaurav?
I think for me, this is one of the best management teams on the ASX, and I sometimes think we confuse a good business with good management. Sometimes the best management teams are found in very ordinary businesses, and this is not an ordinary business, but it's by no means an extraordinary one. But the management here, I've been covering this stock for more than 10 years, and it just, every time I hear from these guys or go through a report, it's a pleasure, because it's so honest and so clean, and everything's upfront, everything's honest. And I've owned this stock in the past, we own it in our portfolios, and it's one of the stocks I can go home and sleep about and know that when I wake up the next morning, I know management's getting up and working diligently and competently every single day to extract value out of the company. And you can't say that for a lot of companies, I've got to say. So for that alone, if you're a long-term investor, especially if you're a conservative investor, I've got a $19 buy price on it. You can forget about that and you can buy it now. I think there's enough value on the table. That $33, I would just moderate that a little bit. Feel like there's some deferred tax liabilities they'll have to pay to realize that value, but your point's still well made and correct. There's a lot of latent value on the table here. Most of the value, as Phil correctly identifies, is in Soul Patts, which increasingly the cash flows is backed by New Hope. I personally own a huge stake in New Hope. Our funds own a big part in New Hope. If you can't invest in New Hope because you've tied your hands for ethical reasons, buy some Brickworks. This is all the cash flow going into New Hope will flow through to Sols into Brickworks. This will be the only manufacturer of bricks to consistently pay dividends for years, because these manufacturers are going to have difficulty accessing energy and then accessing free cash flow. So for that reason, I think I'm going to call it a hold. But as I said, if you're a long-term investor, you can still buy this sensibly. I'll quickly point out that the expanding in the US and the US business, I was skeptical at first, but having gone through it in a bit more detail, looks really good. The brick supply there is almost an annuity stream, because a lot of it is specialty fashion bricks, and but I think half the revenue there comes from just resupplying old buildings with specialized bricks that no one else can do. So they just did the Chrysler building in the US, and there's a very specific type of brick that goes onto that building, and only they have it. So it's a really nice expansion, and it just shows you that the care with which this business is managed. A lot of companies throw away capital in this industry. This is not among them.
All right, let's wrap it up. Second half of the show, Deterra Royalties, hold from Phil, certainly likes the dividend. Gaurav also a hold.
Frustrated hold.
Yeah. Potential that may dilute its royalty there with others that it's considering. Kina Securities in Papua New Guinea, a speculative buy from Gaurav, does come with risk, therefore Phil has a sell on it. A Flight Centre, a hold from both. Jupiter Mines, a spec buy from both, if you like, manganese.
Phil got me on the line, yep.
Get into it. And Brickworks, a buy from Phil and a hold from Gaurav. Well, thank you to our special experts here. Gaurav, thanks for joining us from Intelligent Investor.
Thanks, guys.
And Phil from Shaw & Partners.
Thank you.
Great to see you both. Cheers. All right, and don't forget, if you'd like us to cover a stock, flick us an email, the call at ausbiz.com.au, or you can tweet us at ausbiztv. Coming up next, the small caps. Stay with us.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.